One of the big trades since it was announced that Donald Trump will be the next US president has been the selling of bonds, steepening the yield curve. But what does this mean? We'll also take a look as well at China and the devaluation of the Chinese yuan. Sean Corrigan joins us now from Hinde Capital. Sean, welcome.
Hello, Jim.
First of all, the steepening of the yield curve. Why is this happening, first of all, and what does it mean? Distill it down.
Well, why it's happening partly is because the yield curve had got not only too flat, but long yields were far too low. I mean, as we know, every central bank, the Bank of Japan, the European Bank, the Bank of England, not the Fed for the last few years, but prior to that, has been buying long bonds as an act of reducing interest rates, trying to encourage people to buy risk assets, not to save money to spend it, so on and so forth. And so to some extent, this is a back reaction. We're going back to more normal levels, given the settings. It's very dramatic in price terms because, of course, as we've crushed yields to, and in certain cases, beyond zero in long bonds, this means they're very, very sensitive, more sensitive than they've ever been to small changes in interest rates. So the yield backup, while it's been quite dramatic, has not been unprecedented. But when you look at the price change that has involved, it's been enormous. So it's obviously excited a lot of comment.
And what's the net effect of all this? We hear about the higher dollar as well. It's come at the same time as this Trump announcement and so forth. Does that have a tendency to push up the dollar in any event, or is the dollar move something different?
Well, I think the issue here is also that this was beginning to come anywhere. We've heard a lot of central banks. There's, this strange way that the good and the great all get together and they all suddenly pop up all around the world in Frankfurt, in Washington, wherever, and they all say more or less the same thing. They give the same speech as if high command has told them to say it. And they've all been talking about central bankers, finance ministers, and the sort of talking heads like Larry Summers outside all of that. They've all been talking about how the world would be better if long-term interest rates were higher, and therefore the central banks didn't have to push short-term interest rates down through zero and cause all the side effects. They become very aware of the side effects, particularly on the banking system, particularly on pensions and insurance companies. So what they would like is they'd like slightly higher nominal interest rates at the long end, which they're getting. They'd like inflation to go up a little bit so that theoretically the burden of that is softened. And then they'd like not to have to push short-term interest rates down any lower. Once they started talking about this, people realized that QE was probably at an end. So there was a natural reaction to take the last down move out of bonds anyway. And then with the Trump thing, we're now into kind of everybody has said, all the people who didn't know he was going to get elected 2 weeks ago now know exactly what he's going to do. And what he's going to do apparently is do what Ronnie Reagan did and run a big budget deficit, spend lots of money, cut taxes, which of course means there's more federal borrowing, there's more spending, there's possibly more inflation. And so this is another reason to push bond yields up.
As an economist, are you happy that we've got the growth to go along with that? Are we all going to be in good, high-paying jobs to support higher inflation? Or is that the problem here?
Well, yeah, this is the thing. I mean, if it doesn't filter into wages, then you are reducing real wages. The individual person's stress is heightened. It can be that you employ more people because the cost of labour goes down, but then we'll all be moaning, as we have been for the last 5 years, that we only have low-paid, low-productivity jobs. So it's not a route to prosperity. It might be a softener and a sweet fix, but of course this was the sweet fix that we did for 30-odd years after the Second World War and ended up in a terrible mess in the 1970s and 1980s.
The financial crisis we had in 2008, much of the recovery from that was based in China. China was spending a lot of money, it was buying into a lot of the base metals because it was building a lot and so forth. China's done all that now. The US, yes, they've got some infrastructure spend and maybe that could well help us recover a little bit. But you've just written a paper talking about what's going on in China at the moment, and you were saying about the drop in the yuan. Is it a devaluation? Is it depreciation? I don't know what your interpretation of that is. And why is it happening, and whose fingerprints are on that?
Well, I think the thing is that the yuan had been fairly stable and at very low level, very high, low numerical levels, but a high valuation of the yuan against the dollar up until the stock market bubble collapsed last summer. And thereafter, they let it go, and it moved slowly higher. Now, there is an element, what I think is happening here to start with, that not enough people talk about, is that they became so annoyed at the Japanese devaluation, which Abenomics was pushing in at that point, that these two were obviously big competitors, and they're not politically very friendly with one another either. So I think there was an element that the yuan was moving to try and offset something to do with the yen, and it was the dollar impact was actually a side effect. But whatever the reason, they moved it onwards. Now, as they've bled foreign exchange reserves from their system...
This is the Chinese.
This is the Chinese central bank. The Chinese central bank had $3.5, nearly $4 trillion stockpile of foreign exchange reserves. And basically, the core money on which everything else is pyramided in their system was largely based on those foreign exchange reserves, which they built up over all the years of trade surpluses, plus lots of offshore borrowing, some of it illicit, but a lot of it perfectly sanctioned and perfectly legal and above board. Now, to some extent, they're unwinding that because now it's not, the advantages certainly are not there. There's a knock-on effect that as the yuan weakens, that means that your dollar borrowings are getting more expensive, so you want to get rid of them. So there has been some element of this move has been paying down. They've also been investing a lot abroad, whether it's in other people's bonds or particularly in other people's companies. There's been a lot of foreign direct investment outflow now for the first time rather than an inflow into China. But in the background, there's this element of the money's coming out. This theoretically should contract the core, this high-powered money, as we call it, that the People's Bank of China has. That should tighten the credit system everywhere, and that in itself should put a brake on the outflow of foreign exchange. This is a mechanism that goes back to the 18th century when David Hume used to talk about the specie flow mechanism. But what is actually happening in the meanwhile is that, particularly in the last year, the Chinese central bank has been making sure there is no contraction by putting lots of internal funds into the system. They're doing all sorts of repos and special lending operations and one thing and another, and they have more than offset the loss of foreign exchange, right. Which of course means that the foreign exchange is not getting, or the yuan credit is not, and the money supply is not at all getting scarce. In fact, of course, it's grown at 20-25% in the last year. So whereas a couple of years ago everybody said the minute that China sees an outflow of foreign exchange reserves, it will crush their credit system and everything will fall apart. Well, no, because the central bank can sit and do it internally. But what that means is that it can't affect any control on the currency externally. So I don't know if they're deliberately driving it, but certainly maybe their priorities are such that they just want to keep this domestic situation, all the plates spinning, and so they have to give up on the other thing. But this kind of means there's almost no limit to where it might go while this is going on. And of course the danger is that once everyone else becomes aware of this, they do accuse the Chinese, the Americans particularly and the new regime, accuses the Chinese of doing this deliberately, and then we have all sorts of strife potentially.
It sounds like perpetual motion until perpetual motion stops, of course. And when it does stop, what happens? What's the net effect of all this? We hear a lot about the fact that China's got a lot of debts, the banking system's under strain. We're not too sure about the statistics that are coming out from China. Where do you see the end game here? Is there a real negative to come out of this? Are we building up something that could be quite catastrophic globally?
Well, the end game, the problem is that there's another old phrase, it's an Adam Smith phrase actually, there's a lot of ruin in a country. So China, all these steps to keep the credit structure in place and add another new layer of debt every time they want to do a new program, ultimately is storing up problems. But while they have control over most of the system, and they do of course through their state-run banks and state-controlled companies, they can keep shuffling things in and around from one balance sheet to another for a long time to come. Now, they're not doing themselves any good here because there is the risk that they clog everything up, that they end up with the sorts of problems we've had. But when will that be? We've known this has been the tendency for 10 years or more now, and certainly since they expanded dramatically in the wake of the financial crisis. We've known this is the risk they're running. Every year it's a new crisis that never happens. So who knows? At some point, it cannot fail to be a time of hardship and upset and upheaval. But that could be in 10 years. Well, if a big economy like China has problems, I don't think we're not going to feel the ripples somewhere, are we? But when will it be? Who knows? You can't keep playing for it. You have to watch it. You can't keep playing for it. At the moment, they keep finding ways to patch it up and move the problem somewhere else. Yeah. Long may it rain, as far as we're concerned.
Yeah. Okay. Look, we've got to leave it there. But thanks indeed for coming along to explain what is essentially quite a complicated system. But Sean Corrigan there talking to us from Hinde Capital.